Good morning. Good morning. Hope everyone's doing well out there. Happy Tuesday to y'all. Been a pretty crazy several weeks, and it looks like it may get a bit crazier before it gets less crazy. Got a lot to talk about on this week's edition, so it should be a fun show. Hope everyone's having a great day out there. It is time for this week's edition of Back to the Futures with me, Markets and Mayhem. And we've got a fair amount of ground to cover today, both in the pre-market session with some of the charts I want to cover, and then I expect it could be a pretty interesting regular trading hours session today as well, which would be a departure from what we're used to. So first and foremost, always manage your risk first. Do not focus on the goal. Focus on managing your ability to stay in the game. That is such an important part of trading. I know a lot of folks get caught up in the idea of retiring early and getting rich and not having to worry about working anymore. And those Those are goals you could maybe think about in the long run, but in the short run, it's all about actually learning how to trade, learning how to manage your risk, learning how to prevent the fourth shape. No one wants that to happen to their account. Certainly, I don't want that to happen to you either. I know some say it's part of a trader's journey. You've got to blow an account or two to kind of get your bearings. But I would counter that by saying if you can learn from the mistakes of others, if you can appreciate the magnitude of how important risk management is, if you can look at trading like a business where you have to keep the doors open, meaning you always have to have liquidity in your account, then the pinnacle, the most important part is managing your risk and ensuring you have capital. The rest can come into line as time goes on. It's not about putting it all on black. It's actually quite the opposite. It's about taking small calculated bets over time to grow your account, to also learn more about what kind of trading works for you and your personality type. It might be different than what works for your friend or what works for me. You've got to learn about yourself. This is, in no small part, a journey of self-discovery. One of the things that I like to talk to people about is the math behind climbing out of steep losses. The math doesn't lie. The steeper the loss, the more difficult it becomes to be able to make that money back. And this is true whether you're an investor or a trader. If you're a trader, you might take that loss, right? So maybe you take a 20% loss and now you've got to make 25% back on your next trades to get back to break even. If you're an investor, you might say, well, over the long run, these things tend to recover. That is true at the index level. That is true of some of the more accomplished blue chip companies. But when it comes to stocks in general, a lot of them actually don't make it. So this is an important part of considering risk management as well. All right. So I just changed the effect setup a little bit. Hopefully that's better for you all. Let me know if the mic sounds better on your end. And good morning to all those out there. It's actually not the mic. The mic is fine. It's some of the effects that I try to use so I don't have to do it in post, but I don't want to overload the CPU here either. So it's a balancing act. All right, so we'll pick up where we left off. And basically, the math behind portfolio loss is such that you can't simply try to either, let the loss accrue. It's really problematic to do that. You've got to cut these losers early. And this is true for trading and investing as well. I mean, obviously, there's going to be exceptions to the rule more often in investing. If you have a really good company and it's getting beaten down, the market misunderstands it. Sometimes it can turn around, make that all back. But that is a completely different situation, and it is an outlier situation. So you've got to be incredibly confident of your analysis. For trading, though, I think you've got to set a hard and fast rule of A, not putting more than 1 to 2% of your portfolio at risk, and B, and probably similarly important here, making sure that you have a hard stop that is based on the inherent volatility of the instrument. If you're trading something super volatile like Bitcoin or natural gas, you're going to have to use a wider stop than what you might use if you're trading the S&P or treasuries or Forex or otherwise. Sizing the stop is really, really important And the reason for that is if you're trading something more volatile and you're using a stop that's not appropriate for it, you're going to get stopped out. You're going to get chewed up. That's going to hurt your account. Now, when you widen that stop out, you're taking more risk, which means proportionally you should shrink the size of that position. You see what I'm saying? It all is calculus in terms of risk management. Something is more volatile, you take a smaller size so that you can accommodate a larger stop. If something is less volatile, you could take larger size because you're running a smaller stop. That's sizing based on the volatility of the instrument, and it's so underappreciated and it's so important. So that's one of the reasons I wanted to just take a quick moment and talk about sizing based on vol, because I know a lot of traders are not doing it, and I know a lot of traders would strongly benefit from doing it. It also means your favorite high beta stock, which might be a short squeeze or a shitco company, or maybe it's like a really awesome company that's just having to turn the corner in its growth narrative. Those positions, if they're just trades, should be smaller too. If it's high beta, what does that mean? It means you need a wider stop, which means the position should be smaller. That's part of the logic on setting this stuff that's so important. It doesn't get talked about enough. So I try to give that as a part of my Tuesday sermon, just to help folks with the lesser discussed stuff. And again, I know it's not super sexy, lottos and Lambos, all that, but at the end of the day, it's not really about that. That's an illusion, that's marketing. The reality is, trading, you actually want it to be boring. You actually want lots of small winners, and you can get some big winners here and there too. There's no problem with that, but those are outliers. You can't hold on to every trade thinking it's going to be your next 100 bagger or whatever the unrealistic expectation might be. So a bit about me. I started trading in 2005. It's been 21 years of a amazing journey, ups and downs like anything else, especially early on. But as time went on, what I realized was the ups and downs, particularly the emotional part and the impulsive part of that journey, had a lot more to do with leaning into emotion, leaning into gut feel, leaning into discretionary trading. And so over time, I evolved my system and my approach to be much more systematic, to be much more data driven, to be able to generate back tested signals that I execute on rather than just sort of looking at lines on a chart, hoping for the best. And look, if that works for you, and I know it works for other people, or at least they say it does, that's awesome. For me, and this isn't just for me in my own experience, it's for me also in the experience of talking to other traders that have been doing this for a while. Folks that have been at the game for years, that have developed consistency and success, they are more often than not systematic in their approach, because it goes back to the idea of you want trading to be boring. I know that sounds odd. There's people like, oh, I'm on the edge of my seat for this trade. I'm watching every tick. Doesn't that sound exhausting? If we're being honest, should it really be like that? I don't think it should personally. I mean, if you go in every day and it's like, this is make or break, the amount of stress, the amount of burnout, the amount of time wasted, it's not constructive. We should optimize to use our time in the most constructive ways possible, especially with so much out there that can help us to maybe not even automate, but at least make smarter uses of our time. You can then scale up to automation later if it makes sense to your process. But something as simple as, say, for example, getting into a trade and placing a bracket order. So you have your reward and you also have your risk off level hard coded in. At that point, you should be able to step away from the screen and go do something else, whether it's researching your next trade setup or polishing your skills or reviewing your journal and figuring out how you can improve. That's a better use of one's time. You're not going to gain a lot of value just staring at the screen if you're already in the trade. And if you're looking for setups and just staring at the screen the whole time, might I suggest setting some alerts? They can be alerts on all kinds of different things. Like in Bookmap, I set alerts for when there's an unusual amount of stops or icebergs or absorption or sweeps or other kinds of alerts that basically give me a sense that, hey, you should turn around and look at that screen. There's something going on there. Also, we'll set price alerts at key levels, like if something's breaking above a pivot and I should be watching for that and how that move might continue. That's another alert I'm going to get. So I like to do that in the way that I balance out how I'm utilizing my time, because time is a resource that we feel like we have an abundance of, but in reality, it's actually very finite and it only runs out. You can't replenish it. So the moments that we spend just sort of blankly staring at the screen, those are moments we can't get back and apply towards other things. So that's why I really do favor that systematic approach, because not only is entry quantified through data and testing, but so can exit be somewhat automated through something like a bracket order or a trail stop or otherwise, so that you're not left simply staring into the abyss, because that will over time erode your patience and burn you out, and then you won't be able to focus the way you want to. So, my thought on that: focus more on taking a systematic approach, on placing orders, on pulling away from the screen where you don't need to be hyper focused. And a system doesn't mean anything if you're not significantly testing it. If you're not spending a lot of time looking at that system and essentially making sure that you have some sense as to how you can manage it while you're trading. It's one thing to have a brilliant set of rules. It's another thing to actually be able to execute on them. And that's one of the most important parts about having discipline, is you're creating your strategy. Now, when the market's trading, you're actually utilizing that framework. Let's get into the big picture. We've got just about 16 minutes before the opening bell. Good morning, Stephen. Good morning, Tom. Good morning, Prince. Michael, Joe, Frank, good morning, everyone. Hope everyone out there is having an awesome week so far. So we all know that we are in this regional conflict. It is a war. And this is really what the markets are hyper focused on. And I'll be honest with you, if you told me we were coming into 2026 and you're going to have a war with Iran, the Strait of Hormuz closed, all the stuff that's going on, I would think the market would be more perilous, more fragile. The reason it hasn't been is it's been an incredibly well hedged market. Almost like decision makers at some of the biggest firms knew in advance that some kind of event was coming on down the line. All right, I'll take off my tinfoil fedora. But the amount of hedging that happened ahead of this conflict is one of the reasons that the downside had been buffered. It's why it's been more of this sort of mechanical stair stepping down that we've experienced, where sharp starts getting a little ahead of myself here, but this is what everyone's watching really. It's the Strait of Hormuz, and it's where about a fifth of the world's energy supply transits. It's effectively closed right now. We've heard headlines like maybe it'll be open up for select countries like China or Japan. We've also heard headlines from the US and NATO that it must be opened and that there might be a more military approach to trying to open it up. There were rumors last night of Iran's energy infrastructure being struck after that deadline that Trump set on Saturday night wasn't met. That is to say that basically, if that's true, that could be the next stage of escalation. I'll have to dig into the headlines a bit more this morning and see what's all going on in the world around us. But at the end of the day, it doesn't seem like we're close to an end of this conflict. It's a bit of a Pandora's box that's been opened. And that has a quantifiable effect on the availability of global energy. Sure, we can reroute a fair amount of that energy, but at the end of the day, even with all the rerouting possible, you still have a shortfall of about 10 million barrels a day, down from 16 million barrels a day, as long as the strait is closed. That is enough to create some structural pressure. It's enough to keep oil well bid, either in the high double digits or the low triple digits. And the longer the strait remains closed, the more those impacts began to be felt. For example, LNG shipments, the last shipment is out. Now it's a matter of how much can be stored. Are we going to start flaring gas? Is there going to be other measures to try to transport it elsewhere? It's becoming a big issue. It's becoming a bottleneck, not just for petrochemicals, but for plastics, for pharmaceuticals, for fertilizer. So the longer it remains closed, the more likely it is that you have both supply chain disruptions and inflationary pressure. Neither of those are things we want. It also has an impact on energy inflation directly. And of course, the price of energy has an impact on inflation in other areas. So it goes back to what I was saying. The longer we remain in a situation where energy is well bid, where the strait is effectively closed, the more likely that this creates cost push inflation, which then has the impact of raising prices here and abroad and also keeping central banks on hold, even if the economy starts to weaken. And we can see investors preparing for this, traders preparing for this, rolling heavily into energy equity is really the biggest amount of activity we've seen in that space in over a decade. Meanwhile, everyone's getting out of gold as well. I'm not sure if we could call that a capitulation sell quite yet, as there's been some continuation here, but I'd certainly say we're closer to realizing that outcome. And we'll talk about my line in the sand for gold as well in some of the subsequent charts. Hedge funds have also been de-risking. We can see that across several metrics. This is something that makes a lot of sense given the atmosphere out there. Even if they are well hedged, they're going to start to close out some of their longs. Some of that pressure is starting to build up in some of the more concentrated areas of the market. We can see that with the momentum in the NASDAQ. This is one of the custom indicators I've built. Basically, when orange is above purple, that's bad for tech. When purple's above orange and it's trending higher, that's good for tech. We've been in a that's bad for tech environment pretty much since early February. You can see it in the momentum of the Mag 7, but you can also see it in this chart, which looks at a composite of momentum within the index and tries to qualify not only where we are, but where we may be heading. Suffice it to say, tech still has strong negative momentum. Good morning, DigiDollar. Good morning, Antonio. So the next one we have here is a chart of the Mag 7 forward PE. And boy, has this thing taken a discount. In fact, it's a bigger discount than what it took during the bear market of 2022, just to give you a sense of how much this stuff is being re-rated. So even though momentum right now is very negative in the Mag 7, eventually these things, some of them within, are going to be big buys. I'm still constructive on Google. Of all the stocks in the Mag 7, that is my favorite by far right now because they have what it takes to really be a formidable leader in the AI race without kneecapping themselves. They really understand the tech. They built a full stack. We're talking the hardware layer with their TPU inference chips, their inference layer, the software that runs the models that they built themselves, and the agents that run on top. I think they're the only full stack publicly traded AI company. Obviously not a pure play, but they invented transformer models back in 2017. So they have credible experience in this space where a lot of the other companies have only entered more recently. Shifting gears to the Fed, no Fed rate cuts planned until October of 2027 if we believe Fed funds futures. They do tend to overreact sometimes. That might be a little bit of what's going on in the thinking here, but if the strait doesn't open soon, this seems accurate to me because you're going to have a Fed that's dealing with inflationary effects that cannot justifiably cut rates without a much more meaningful rollover in the broader economy. Another thing that might be making the Fed and fixed income folks a bit more nervous is the MOVE index, which has been absolutely surging. This is a measure of volatility in the treasury market, and it gives you a sense of just how frayed nerves are there. Yields have been all over the map. The 10-year has been trading more like a meme coin. And if we get above 4.5% on the 10-year note with any real velocity, that is a risk-off area to watch. In the past, moving above 4.5% with velocity has caused more de-risking in stocks, in crypto, and often in precious metals as well. On the other side of it, however, a yield curve steepener is great for financials, and financials, their positioning is quite low. This might explain some of the strength that they've seen recently. Essentially, when the short end of the yield curve is staying flat to going lower and the long end is rising, banks are able to make more on their loans. They are, in effect, borrowing from the short end, lending on the long end. So, seeing that yield curve steepener is bullish for the financials. And seeing this positioning aggregate so beaten down gives you a sense that there is opportunity emerging in this space, particularly in some of the stronger names. JP Morgan is one that's hard to bet against, as an example. We also have hedge funds. They do not seem to be positioned for a stagflationary environment, which is really interesting because everything indicates that outcome is becoming increasingly likely as time goes on. It also suggests that there are opportunities within these positioning metrics, that there could still be opportunities to get long areas like energy, areas like metals and mining, areas like financials, which I think would also benefit from that kind of stagflationary environment if there's a yield curve steepening. So we can see hedge funds aren't positioned for it. That could lead us to opportunity. And adding to the stagflation narrative is Q4 GDP coming in recently below 1%. A lot of the GDP growth that we've experienced has been related in no small part to AI spending, government deficit spending, and the top 20% of consumer spending. A lot of those trends are starting to become more fragile, with increasing concerns about AI capex having the debt markets pull back to such an extent that companies like Oracle and Meta are instead laying off their workforce instead of pulling back on capex. But all those employees losing their jobs in a tech market where it's quite hard to get new jobs is an economic negative, as is the top 20% of consumers starting to pull back on spending as wealth effects go negative in the market. So these are things we need to keep an eye on. It doesn't say, hey, we're going into a recession, we're all going to die. It's nothing like that. It does tell us those risks on the left side, those left tail risks, are growing. Let's look at the technicals here. We've got about 4 minutes before the market opens, maybe about 5 minutes here. First, the S&P 500 isn't out of the woods until it's back above the 21-day EMA. And I'm looking at that as the orange line on screen. We can see it's been pretty good as a metric for upside momentum. When it's above, the S&P tends to trade a little more clean, a little less volatility. When it breaks below, it gets real volatile. And when it stays below, that helps to define a downtrend. And this has been one where every time we peak back up or get close to the 21-day, it sells, including yesterday. So I think the 21-day EMA can be a very quick momentum indicator. You can apply it to the S&P 500. If we're able to close not the day, but the week above it, that's where I feel like it's more likely we're out of the woods near term. For now, bears have control from a momentum perspective. That means we're going to have these sharp counter trend moves, but the ultimate path of least resistance is lower. The NASDAQ also has a similar look about it. I don't think its downside move is quite done yet. The S&P, depending on what happens from here, it might be closer to that, having hit those November lows, but it does look like a chart that's rolling over. So the path of least resistance for the NASDAQ and the S&P is lower. S&P might be able to try to hold the low here. NASDAQ, I think, can roll lower and probably get back to August, September lows from last year. That has to do with the momentum indicator we talked about earlier. It has to do with the AI capex narrative becoming increasingly questioned. It also has to do with the risk-off mood in a market that's less concerned about tech and AI and more concerned about geopolitics and real-world goods like oil and the knock-on impacts that could have. So you got folks rolling out of tech and going into places like energy as well. We also got the 50-week SMA on gold as the benchmark for the health of its momentum. A lot of people have been asking me, what are my thoughts on gold? My thought right now is that we're still in an uptrend as long as we can hold the 50-week moving average. If we break below the 50-week moving average on a weekly close, then this rally is probably over, or at the very least going to consolidate for an extended period of time. Silver, on the other hand, got right to our price target, peaked below, and came right back up. It needs to hold above 64.53 or we are in trouble. That is to say, if we can't hold that level, we could retrace even more of this move from December in silver. Oil, on the other hand, as long as the Strait of Hormuz is bottlenecked, and this is a monthly chart, so we're zooming out quite a bit, about 10 years of price action on screen. I think as long as it's bottlenecked, that oil bid is going to remain. We have heard, and I think it's from credible sources, that the Treasury is leaning in on oil prices to suppress them. That's one of the reasons they probably aren't materially higher in the here and now. But as long as the strait remains closed, that's going to have less and less of an impact on suppressing price. Bitcoin, in my view, it's still following the theme we've talked about. I think we kind of get a peak above here, maybe to 80,000 and change, and then roll back down to 52,787. I still don't like the look of this chart. It looks like lower highs and lower lows of a part of a broader head and shoulders breakdown. And the US dollar, it is continuing to hold this trend line. As long as it does, it's likely that crypto, emerging markets, and even some of the Mag 7 and leadership multinational stocks are under pressure, as well as things like gold and silver. For the US stocks, a stronger dollar means more earnings pressure from overseas revenue. So that's not a great thing for some of those larger companies. And we've got our weekly pivots here. I'm going to just put this out on social media for you folks to be able to take a look at as well. You'll notice that these have been areas that have been somewhat formidable, especially for the S&P and NASDAQ. And Gory, good morning. I'll take trades if I see them, but I really do like looking at the 20-minute opening range and combining that with order flow from the SPX index to get a sense as to whether we're setting up for a trend day. I'm less of a scalper and more of a trend day trader. So I put those pivots out there on my X feed. You're welcome to take a screenshot of what you see on screen. About to flip over to Bookmap for the open, but I want to tell you, no matter how the market is treating you, whether you're doing really well or really poorly, you need to treat yourself well. Don't beat yourself up. Figure out what's going wrong if you're not doing well. Keep a trading journal so you have that accountability and you can figure out how to improve. And don't be afraid to take breaks. If you need to take a day or a week or whatever off to sort yourself out, do that. Always treat yourself well, no matter how the market is treating you. So we're going to get into Bookmap. We got the market opening here. We're going to zoom into that market open as well. The market open's always fun because it's a cross current of institutional order flow, retail order flow. You got folks that are coming in to sell the open, folks that are coming in to buy the open. It ends up being this really kind of interesting mishmash of different order flow. It's both the first hour and the last hour, and particularly the first 30 minutes and the last 30 minutes, that are the most active times of a regular trading day. Yeah, that's another thing that Stephen brings up that's also really important is be kind to other people. Don't just be kind to yourself. If you see someone that's struggling, if you have an opportunity to help, if you can contribute to causes that are worthwhile, make the world a better place. Kindness costs nothing, but it can mean everything. And we should all endeavor to be the kind of person that's doing the right thing even when no one's looking. Just do the right thing because it's the right thing to do. We do have some data coming up pretty soon. S&P Services PMI Flash and manufacturing and services PMI Flash, I should say, coming in at 9:15 this morning. So for me, I'm trading gold on a swing time frame. I'm not really looking for intraday trades on gold here. It is pretty volatile, and It would be if I was shorting it, I feel like I'd be shorting into a hole, and I'm not quite ready to long it because I want to see how it reacts to the 50 weeks. So for gold right now, I'm just on pause outside of my like some of the investments I have in the space with the miners and otherwise. For the commodity itself, I'm on pause. I'm waiting for that 50-week moving average. Got to see how it reacts. Seeing a little bit of seller exhaustion there, just about 931. It's probably one reason we got a little bit of a continuation bid off that move because sellers got way too ahead of themselves, at least right there. We are seeing liquidity stack above. That is generally a constructive sign. Gives you a sense there's interest in higher prices here. You have a call wall at, see the exact level here. 65.85. So I do like seeing those offers stacked above. That is constructive. We've got VWAP just above us here too, just at about 66.13. That's going to be another level, but you can see it's sort of like carrot and stick. But basically, when you have that liquidity higher than price, you're telling the market, hey, you've got folks out there interested in expressing their opinions at these higher prices. That is constructive from auction theory. So you can see that is helping to pull the market higher here. You're welcome, Gory. Yeah, I do like the 20-minute opening range. I think it's a balance between, some folks look at the 30, some folks look at like a 30-second, some folks look at a 5, 10, or a 15. I find the 20 to be a pretty good balance. I auto plot it on my charts now as well, so I can kind of get a sense as to whether we're building acceptance above or below it, where the extensions are. But I think between that and watching the order flow for the S&P 500 index options can give us a pretty good sense for trend. For example, if you build a 20-minute opening range, you build acceptance above it, and you can see call flow is pretty powerful at the most active call strike, much more so than the most active put strike. That can give you an initial sense that the path of least resistance is going to be higher, and you've got two different areas where you can watch to confirm for that. If y'all are enjoying the stream, feel free to like, share it out there with other folks. The more engagement, the more it kind of gets out there to the algo, so other folks would be more likely to see it. And we can see that just here, we had two small scale seller exhaustion events. Those are lower confidence, so not quite as much meaning as what we had seen just a little bit earlier when we got that bounce off of a larger seller exhaustion event. We saw buyers pull up the point of control, and now sellers are challenging that level to the downside. And let's just zoom out a little bit here. We can see some of the pre-market. We were actually selling off into that pre-market pretty aggressively. So part of this bounce here is really just coming off those lows. Again, we talked about it a little bit before the market opened, but there's plenty of negative news catalysts for the market to be concerned about as well, including with Brent crude now trading over $100 to 103.57. West Texas Intermediate crude trading 92.42, but again, might be just a little discounted from the not so invisible hand out there. Shift over to the NASDAQ for a moment. NASDAQ actually looks like it's giving back most of those pre-market gains. Shifting to the FinViz heat map on just another screen. I always like to look at the real-time S&P heat map to get a sense of breadth. There's a lot of selling in software today. Bigger techs flat to down for the most part. Financials, healthcare, communications, industrials, pretty much everything on the heat map showing weakness outside of energy. Utilities flat to mildly green. Now, when we take a look at the breadth statistics here, it's not surprising to see that there's 29.8% advancers versus 63.4% decliners. That is not the sort of breadth you want to see if you're bullish. So the NASDAQ doing what it's doing and kind of giving back that morning gain, it makes sense given what we're seeing, both in terms of the news flow and in terms of the price action in the market itself. You see really tech as one of the bigger losers today. All we need is Anthropic to release some other tech adjacent product, and the tech side of this market would really roll over again. Similar though, the S&P is starting to give back its gain, so it's following the NASDAQ. NASDAQ, I imagine, yeah, making new lows here. So NASDAQ's really going to be what we need to watch from momentum right now, because it is leading this market. And you can see it in the heat map as well. The way that tech is trading, it's just very, very risk off. You also got pressure on rates. The long end is continuing to push higher. That often starts to negatively impact tech. If we get above 4.5% on the 10-year, I would expect that would intensify. Dollar is also rising today. There is some resistance just above 100, but it is steady here at 99.31, bid up almost 0.6%. That's also going to put pressure on some of these other parts of the market as well. We talked about how a strong dollar, especially if it stays strong, can put pressure on multinational earnings. So you've got rising yields, you've got a strengthening dollar, you've got geopolitical tensions, a Pandora's box. It's been open. It's going to be very hard to close again here, and all that seems to be weighing on this market today. $65.79.75 is a pivot that's going to be worth watching on the S&P 500 as well. Very close to that level here, and testing it now. You know, this selling is not particularly aggressive. It really is more that buyers are just not here. They're not participating. I'm going to put on the delta volume bars on the bottom here real quick. Yeah, Manish, it looks down. It looks down. It is. It is indeed. The headlines that we were getting last night and some of the stuff I'm seeing this morning does not look particularly positive either. So it's not entirely unexpected that we'd see us probably challenge the lower end of that forever trading range, which would be around like ES 65.25. And it's interesting, just like earlier when we saw there was interest in higher prices, and that was expressed up here with liquidity coming in on offers at higher prices. Now we're seeing the opposite. We're seeing some of that liquidity build at some of these lower prices, showing that there is some interest here in lower prices on the S&P. Just zoom in a little bit to a 20-minute time slice. And if we zoom out to the longer time frame charts that we were looking at, pre-market, pre-bookmap, all of them still look heavy on the equity side of things. So it's not terribly surprising to see some continuation of that concern expressed through the price action today. S&P trading down 0.5% alongside NASDAQ. Oh, I misspoke. NASDAQ's down about 0.9% here. So it has gotten worse since I refreshed that quote. And S&P down 0.3%. So not the best looking tape so far. There is a big level down there, as you can predict, at a big round number, S&P 6,500. That is one that's going to be worth watching just based on the options positioning. There's a relatively decent amount of puts down there. Could provide some support during regular trading hours. And we did get our data from S&P Services PMI flash coming in at 51.1, lower than 52 expected, and then manufacturing coming in at 52.4, coming in higher than 51.5 expected, and composite coming in at 51.4, a bit lower than 51.9 expected. So mixed bag. Services weaker, manufacturing stronger. The bigger deal of all would be services weaker because that's such a larger part of our economy. Seeing any kind of weakening there would be important. But fortunately, all these are still growth readings. They're just a little bit of a slowdown in the growth of services based on this measure. And PMI, like CPI, it's a survey. It's survey-driven data. You're talking to purchasing managers, basically getting their vibe on the business environment that they're in. And buyers starting to come back a little bit to this tape, actually showing a little bit more aggression here as they challenge a point of control from below. Starting to see liquidity build up above as well. Order book pretty balanced, 22,000 depth. I remember when the S&P used to have, and I guess this in today's terms, where like an hour is a year, this probably dates me, but I remember when the S&P used to have 50 or 60,000 order book depth, and that was just how it was. And anything lower than that was illiquid. We've been in this market where it's been 25 to 20,000 order book depth for so long that this is sort of the new normal, and it's wild. It's also a lot easier to push and shove this market as a result. And we do have some order flow hitting the tape in the SPX index options. It's pretty interesting distribution, all 1,000 for the top four most popular strikes. Bulls targeting 67.15 on the high side, bears targeting 64.30 on the downside. That range will tighten up. It's pretty big range. And we're just about to close out the 20-minute opening range here. Speaking of ranges, just about 1 minute to go. And it's a pretty chunky opening range. Looks like it's going to be about 30 handles or more, depending on what happens in the next minute here. Really big bid coming in here, about 1,000 on bid at 65.75. We've got a pivot right down there as well. It's worth watching. And they just shifted that lower by 5 handles right before our eyes. So you can kind of see that stair stepping lower. It's a heavier handed version of what we saw earlier to help kind of pull the market higher. You've got the opposite now going on. And that just suggests you've got a rather large desk that wants to execute down there, wants to take off 1,100 contracts at 65.70. Got a little bit of a feed disruption there. We've got our 20-minute opening range, and we are testing the bottom of that opening range now. We've got 1,132 contracts sitting at 65.70, right down here. So basically, if we see sellers sweep that liquidity and get some continuation, that's going to tell us we're building acceptance below the opening range. The sellers have supply to keep pushing. That's going to get us to have a higher probability of a downwardly trending day. Add to it, you also have more weight coming into the put flow than the call flow in SPX. And both of those are starting to suggest that we could have another red day on our hands with more downside from here. The most active put strike on SPX is 64.30 now transacting. over 2,000 contracts, 0 DTE. Now 3,000. And this is a pretty good line in the sand, the 65, 70 area, just because of the amount of contracts that are hanging out there. I mean, it's basically 5% of the order book hanging out at one level. So if sellers are able to push through that, that would give you a pretty good clue that they've got room for continuation lower. If they're able to sweep 5% of the order book, that kind of tells you everything you need to know. On the other hand, if they're not, and right now we are rejecting that level, then that tells you they do not have the supply. A little bit of passive selling above us here. You can see the icons, the 150 and the 40 being iceberg sells. Nothing too significant yet, but worth noting if we see a heavier hand start to lean in. So far, however, starting to look more like a rejection of that resting liquidity. Sellers saying they don't have the supply to take us through there quite yet. So that's a pretty good line in the sand to watch. It's both the bottom of the opening range. It would confirm a break lower, and it would also give you a better sense of the dynamics in supply and demand of this auction. So far, we're rejecting that level, and it looks like buyers might be trying to take us back to the point of control for a retest. And this is a market where I think for everyone trading it, you've got to be real careful with size, because at any moment a headline can hit and it can change the entire narrative. It can change the entire tape. And no matter how fast you think you are, you're probably not going to be able to react. And I know that folks like to use stops, and I encourage it. But the other problem is, if you think you've completely managed your risk with a stop, if you're running too much size and that stop doesn't execute the way that you hoped it would, like there's a really big movement in price and it just kind of gaps around, you can have that stop triggered at a level that was less ideal than what you were hoping for. Now, in something as liquid as the S&P, it's a lower risk. When you're trading things like NASDAQ and it's not as liquid, that risk starts to go up. But be careful about the size you're running in this environment. This is a much more prone to sudden spurts of volatility that can be controlled by headlines that you're not going to know in advance in either direction. So that's a really important part of managing risk if you're trying to scalp or if you're trying to trade trend days. Just looking at RV or realized volatility and IV or implied volatility is not enough to get the full picture. For example, if there was a meaningful escalation in the tensions, you're more than likely to see this market drop by hundreds of points. And it could happen during the same session. Like you have, let's say, all that was threatened plays out. Lots of energy and power, like not just energy in terms of oil, but power infrastructure, desalination plants. There's a back and forth. There's a broader regional outbreak of tensions. That could be really profoundly bad for the market in a short period of time when those headlines hit. Just like on the other side of it, if there were credible peace talks and a de-escalation, this thing could be bid up 3 to 5%. You've got to kind of just contextualize the risk. It's headline driven for the most part, and it's hard to qualify, which means we need to be much more nimble about how we engage the market. So far, it's looking like buyers are trying to wrestle control back from sellers here, a little more aggression. They won't have too much credibility until they first cross above that point of control. Then we've got VWAP just above at about 65.0550. In terms of the flow, puts are still in favor. Downsides, targeted level is 64.75 and 64.50 on SPX. And the most active call strike is 6,600 SPX. There's a 39.75 point delta there. So that would mean the most active put is 6489.75 ES, and the most active call, 6639.75 ES, which you can see with the SPX options visualizer here on screen. We're now challenging that point of control from below, so buyers showing us a little bit more conviction here. We're also seeing some liquidity start to stack above. Gives you a sense that there is some growing interest in higher prices here off this low. It's also somewhat encouraging we didn't break that low, the low of the range. Got just about 2 minutes left on the stream. As always, a pleasure hanging out with you all. I will be back next week, 9 a.m. Eastern on Tuesday. Do these every week, so be sure to come hang out. If you enjoy the stream, like and subscribe. They go out on my YouTube, my X, Twitch, Kick, and Substack every week. And rejecting here at the point of control. That was the line in the sand, at least the first one to look at. So far, buyers not showing us the conviction there yet. Clean rejection right at that level, too. Just like they kind of like banged their head into it and it hurt. Now they're falling down. And you can see that was a level of resistance earlier, several times. Buyers just bumping their head into the point of control and getting rejected. So not a good look for the buyers so far. And rest of the day, calendar is pretty light. You've got ECB's lane speaking at 11:45 a.m. That could be a currency catalyst for the euro dollar pair. You've got U.S. 2-year note auction at 1 p.m. Eastern. Trump swearing in the new Department of Homeland Security secretary at 1:30 p.m. and then the Fed's bar at 6:30 p.m. And also some news hitting the wires just a few minutes ago. Airstrike hits Lebanon's coastal area from that country's state news agency. So certainly no sign of regional tensions abating here overall. Also hearing about the death of some UAE servicemen who were killed while performing duty during Iranian attacks. So there is a fair amount of just around the region signs of escalation worth monitoring here overall. Now, over the long term, wars are often blips. Markets tend to mechanically climb higher on the index level. But while we're in the situation, the market's assessing what all it is, it's still worth watching. Noteworthy, the bid that we had below, gone. And now we're starting to see buyers with some conviction push above the point of control here. Sellers attempting to absorb, so far having very little effect. And ECB also getting some headlines out there saying that they're well positioned to act when needed. So I'm not sure if that was the catalyst for this move, but certainly could be comforting for the markets to hear that. With all that being said, that's going to wrap it up for me. It's going to be worth watching this point of control and the VWAP. Those are the two levels the buyers really need to break above and hold above to start wrestling back some control. Put activity is still in focus with SPX 6450 trading 7,000 contracts. That's ES 6489.75. The hot call at SPX 6600 just trading 5,000 in comparison. That's 6639.75 on ES. So it does look like we still have some downside risks here worth watching overall. Wishing you all an awesome week ahead. I'll catch you next Tuesday, 9 a.m. Eastern for the next episode of Back to the Futures with me, Markets and Mayhem.